That's always been the case. Silver's always been more volatile than gold. It also, though, has, I think undeniably, people call me Darth because of my saying, though, but I think it undeniably has a much stronger response in price to its industrial side. It's always had an industrial side, like it was photography before, now it's electronics and solar panels. But it's always had an industrial side. But that is clearly a stronger variable now. Like it really affects the above ground available stock in a way that doesn't matter for gold. Number one takeaway is, set aside what they say. Because remember, these are the captains of the ship of state. They have to sail the economy the best they can through uncharted waters, right? There's nothing in that job description that says they have to tell the truth. And we know that they regard Powell's jawbone and all the other ones as policy tools. It's part of their toolkit, to say things that will make people act in certain ways that they think are good economically. I don't think that's actually a very controversial thing for me to say, though it may not sound very nice. But I think it's important to keep in mind. It is not their job to speak the unvarnished truth. At best, they spin it, massage it to try to push things in the right direction. So, whatever they say, the fact is, inflation has been going the wrong way for 6 months. It's 50% above target, whereas unemployment is supposedly at record lows or near record lows, and they're cutting. So if of the dual mandates, if one is 50% above target and one is not a problem, why are they cutting? What are they not telling us? I think that's not a conspiracy theory. I think that's a reasonable question to ask.
It's pragmatic thinking.
Clearly, there's more weakness there than they're willing to let on. And another thing that they're not saying is transitory. But clearly, they either think the inflation is transitory, because they're not acting on it, or they know it's not, but maybe they're not worried about it going too much higher. They know it's not going away, but basically 3% is the new 2%, right? They know it's not going away, but they don't think it's going to get much worse, so they're erring on the side. But either way, what we end up with is weaker economy, high inflation, above target, stagflation. And we all know, what happened the last time we had a serious bout of intractable stagflation in the U.S. By the way, sorry to interrupt myself here, but people often say, Lobo, you talk about the U.S., the Fed, so much. The world is global. Gold is a global market. Well, but we tend to quote the price of it in dollars. The gold-dollar exchange rate, I like to call it. So what happens with U.S. policy to the U.S. economy, the U.S. dollar, is relevant not just to gold, but to all commodities. And it's also the world's largest economy. So it's not irrelevant, even if you live in Switzerland or Shanghai, to pay attention to what's going on in the U.S. So anyway, my key takeaway is what the Fed is saying without saying is that we're in for stagflation, and makes me nervous, because to say we're in for stagflation, the obvious corollary is, so that's good for gold and silver. But with gold over $4,000 and silver close to 50,
how much better can it get?
Right, and I'm sure you have plenty of guests who will argue why it has to go to 6,000 or 10,000 or whatever. And I'm not saying they're wrong. It just makes me a little nervous, because we had a hockey stick from 2,500 up to 3,000. We waffled a bit, and then we got another hockey stick. So if it hockey sticks again, that's 3 in a row. That's a pretty tall ask. I'm not saying it can't happen. Could be the stagflation story kicks in, and we end up with, Goldbug's dream come true, right? The next blow off top. Though, honestly, and I'll let you go with the next question here, I would much rather see actually a period of consolidation. I think that would be healthy, and it would give me greater confidence in the longevity of this gold bull. Whereas if we go right away into that blow off top, we all know what happens after the blow off top. And so don't forget to take profits.
Really good point. Absolutely.
Economic messaging today suggests resilience, yet policy behavior reflects caution. Whether officials believe inflation will settle naturally, or they've quietly accepted a higher baseline where 3% becomes the new normal, the outcome is the same: a lukewarm economy paired with persistent inflation. This slow burn environment resembles the early stages of past stagflationary episodes, where growth stagnated while prices crept upward. And because the US dollar anchors global asset pricing, especially commodities, America's monetary stance ripples across the world. The uncomfortable implication is that policymakers may already recognize a stagflation framework forming, but prefer not to announce it outright.
Obviously from 5 billion, I mean, that's not even a rounding error in the big picture of things from policy. I think the bigger signal, if you will, is that if you're going to go from QT to QE again, at some point you have to go to zero. The rate of change, at that inflection point has to go to zero. So the takeaway from here might be that what the Fed is actually signaling is that they're worried enough about the weakness they're not acknowledging that they're setting the table, priming the pump for QE, which would, again, that's inflationary, would be obviously bullish for anything real, including monetary metals.
Periods of high inflation and weakening growth historically favor precious metals. With gold above $4,000 and silver near $50, investors are asking whether the rally can continue or whether a peak is forming. Rapid hockey stick surges can turn into unsustainable blow-offs, especially after multiple consecutive spikes. While some analysts foresee $6,000 or $10,000 gold, a vertical surge would risk a painful correction afterward. A healthier path would be a multi-month consolidation around current levels, allowing markets to absorb gains and build a durable base. Sustained strength, not runaway euphoria, would support a longer, more profitable metal bull cycle.
No, 100%. And do you see that happening though, QE? Like, if you were to read the tea leaves, is it really upon us again?
Yes. See, one of the issues that we have is like we're looking at things, and the bulls, economic bulls, they're saying, well, gee, the economy's not so bad. Look, unemployment near record lows and so on. But if you've got this K-shaped economy and you look at, like spending, everybody's keeps scratching their head. Well, gee, if there's weakness in the economy, how come spending keeps holding up? Well, it's not that big a mystery. Even on mainstream financial media, you'll have people admit periodically, well, yeah, it's the top 10% that are doing the top 50%, or, right? So if you net that out, the people on the bottom rung of the K, they're not doing so great. And that matters because you could say, oh, well, it averages out. Like, for example, one of the interesting numbers going around right now is that if you took out all the data center builds, this last quarter of growth was basically zero, like 0.1%. But it averages, with the data center builds, it averages into looks like a fairly healthy amount of growth for the U.S. The GDP now forecast is currently like 3.9%, which is like, wow, for an economy as large as the U.S. to be. But if that's mostly data center builds, what does that imply about the bottom rung of the K? Right? And this matters because A, it's real, there's people who are suffering, and B, there's more of them. Okay, maybe the billionaires spend as much as the people on the lowest rung of the ladder, but there's more of them and they vote. So if you're asking me what's the Fed going to do, you could look at the average statistic and say, oh, well, gee, things aren't so bad. But their political masters understand that voters will be very unhappy in large numbers if they don't address the bottom rung of the K. So, could there be QE despite inflation? Like, imagine that we don't just stop the QT, but we're actually doing QE and cutting rates, and inflation continues higher. I mean, obviously, if it goes screaming back up to double digits or something, they'll change course. But if it's just, wafting around 3, maybe heading up towards 3.5, they could still do that. And if you're talking 3.5% inflation and job destruction for the larger number of people on the bottom part of the K, that's very much like the 1970s. People talk about Volcker raising rates to 20% or whatever, but the inflation, it spiked high, but the average, and when people were getting upset, like it was around the levels that we're talking about now, right? Right? I mean, zero inflation was the aberration, So it's really interesting to me. And you're asking, so I'm answering the questions with what I think. Because I just want to make clear that I'm not predicting like gold's going to the moon. But it's striking to me that we're heading into an environment that should be bullish from gold, and we're heading into it from a level from 4,000 that's kind of exciting. This is the equivalent of me pounding the table, I guess. I try not to do that, right? But one more thing on this.
Yeah.
It's really interesting to me that gold is doing that beach ball thing. Like it's gone under 4,000 and it just keeps coming back up again. And when gold hit almost 4,400, right, and then rolled over and it started going down, it was reasonable to say, where's the floor, right? And a reasonable, at least psychological, if not technical level would have been 4,000. Does it hold 4,000? Because if it kept going down through that, the technical guys would say your next Fibonacci is like 37 and change or something. That would be a significant pullback or a much bigger one than we've got now. Almost officially a bear market, right? So the fact that it doesn't seem to be going there, that it's catching a bit, that's really telling to me. If this continues, the longer this 4,000 consolidation goes, like if it did the same thing at 3,000, did the same thing at 2,000, and then what happened? It went up to the next big leg up. So the longer this consolidation goes, the more confidence I will have that the next big move will be up, not down. Right now, honestly, the next big move could still be down.
Yeah. So usually that bullish flag pattern that we're seeing. Or that
I'm not a
pattern,
TA.
right? I was saying
I'm not a TA, but yes, actually. So I think Christopher Mullen, who is, I think his morning talk this morning was actually pretty bullish on that basis. And I can't say more. He's the expert, not me. But I'm more just looking at like how long we consolidated for a couple years over 2,000, and it dropped pretty low, like 1,700. What it was, I forget what the low was after 2,000. Lower than 17. Anyway, consolidated for years, but waffled around that range, and then it did the same thing for less time over 3. And if it does the same thing now, I don't think we'd have to wait that long because you've got the central bank buying, you've got mainstream waking up to gold. Gold being a crowded trade this year, on Main Street at least, sorry, not Main Street, on Wall Street at least, a crowded trade. So the ingredients are there for a real flavor of the day. Like the kind of market mania that happened in the late 1970s and 1980, which didn't really happen in 2011. Like, the shoe shine boy giving you gold stock tips and stuff. That didn't happen in 2011.
Talk to this guy sitting over there.
Yeah, we should. Yeah, scuffs
we
on my
see
shoes.
what he recommends these days.
But that's not just allegorical. Like I was the shoe shine boy in 1979 and 1980, and I wasn't buying gold because I was a shoe shine boy, but I was buying silver. I was buying Morgan dollars. Every babysitting job or lawn I mowed, I caught the fever. I put every penny I could into silver dollars.
Even as officials highlight strong spending and low unemployment, deeper data reveals a split economy. The top 10% continue to drive a disproportionate share of consumption, while households on the lower rungs face tightening budgets and job pressures. Without data center construction, recent GDP growth barely registers. This imbalance carries political risk. Large voting blocs feel squeezed even when averages look healthy. That reality increases the likelihood of renewed monetary support, possibly even QE, despite elevated inflation. If policymakers prioritize stabilizing household conditions over rigid inflation control, the U.S. could revisit dynamics last seen in the 1970s, with significant implications for hard assets.
That's always been the case. Silver's always been more volatile than gold. It also, though, has, I think undeniably, people call me Darth because of my saying, though, but I think it undeniably has a much stronger response in price to its industrial side. It's always had an industrial side. Like it was photography before, now it's electronics and solar panels. But it's always had an industrial side. But that is clearly a stronger variable now. Like it really affects the above ground available stock in a way that doesn't matter for gold. So that's interesting to me. But I'm actually not even, that's not even where my head is on that. I do think that the thing I'm watching is that even your most diehard silver uber bulls will tell you that silver lags at first, but it's okay, don't worry, because silver always catches up at the end, more than catches up at the end. Fine, I agree. Historically, this happened 9 out of 10 times. But if we're in the catching up at the end phase, that implies that we're in the end phase, right? And I don't think that's true. So it was concerning me that silver recently was screaming north faster than gold was. But we have a proximal cause for this: the physical squeeze in London, the the price to borrow silver in London to meet physical demand, skyrocketed enough to fly some silver from New York back to London, and apparently more of it came from China to help resolve this. But I like this because silver's kind of reverted to trend. Like it started more than catching up with gold, and now it's reverted to trend, and that's good for the longevity of this market. You have more time for all of us to make money here. And this is an important point. My job, what my clients pay me for, is to help them make money, not to be ideological or religious about defending silver or gold or uranium or whatever it is. So don't get mad at me if I talk about taking profits or markets going up and down. The purpose is not to be a cheerleader for your favorite commodity. The purpose is to make money. And we make more money, I think, if we have years to go in this bull market, which ultimately takes us higher than if we get a blow off top now and then we have a bear market for years. Right? So silver accelerating was worrisome because it might have signaled the end of the market. And silver correcting more right now brings it back to trend. And for me, that's a sigh of relief. The bull in monetary metals is stronger this way.
Gold's behavior around the $4,000 level has shown surprising resilience. Each time it dips below, buyers push it back up, much like a beach ball held underwater. This repeating pattern resembles earlier consolidations at $2,000 and $3,000 that eventually launched powerful new advances. The longer price stabilizes here, the stronger the foundation becomes for a future breakout. While a downside move is still possible, the repeated support suggests robust underlying demand from central banks, institutional investors, and individuals seeking stability. If this range holds, the next major move is increasingly likely to be upward rather than downward, continuing the long-term bullish structure.
I want to talk a little market sentiment as well, because we've both been in the mining space for a long time, and I'm still nervous when I see like down days. It's like, oh, is this the end? Right? Is this the end of the rally? That's sort of what gave me the idea for that question here, because the GDX, GXJ corrected quite a bit as well. Overcorrected, in my opinion, a little bit. Is it based on that nervousness that we've seen? Did it overcorrect, or does it?
It depends on what you mean by nervousness.
Like, we're always like the whack-a-mole game, right? Like when we ever get excited.
What I'm saying is there's nervousness and there's nervousness. One kind of nervousness is this is it, the market is done, we got to get out. And there's nervousness of, oh, it's gone really high and maybe it's time to lock in some gains and things. And it's quite different. And this is why I think the beach ball thing with $4,000 gold is so important, because if it was the nervousness that, oh, like this is a nosebleed valuation, it's irrational, it's got to pop and then go into a bust mode, which we could say about other markets today, maybe. If that's the nervousness that we had, I don't think gold would have stopped at 4,000. I mean, I think it would have blown through the Fibonacci and easily gone back to 3,000. Maybe even lower. That didn't happen, or at least hasn't yet. That's why I say the longer we consolidate here, the less I worry about that. Whereas the nervousness that, oh, gee, this is faster than we expected, clearly there was a yes there. There were people who were ready to lock in gains the moment it seemed like things rolled over. And by the way, I was one of those.
Fair enough.
And you can hate me if you want, but it wasn't just me. Our good friend Rick Rule, on recent interviews, he's mentioned reaching the point of no concern, as he calls it. And this is actually an important point. It's not like Rick is now bearish on gold and silver, nor am I. And it's not like he's completely out of the markets. He's just sold enough that he has no risk, like he can't lose. I've sold enough that I've actually locked in gains. So I can't, not only can I not lose, I can't not make money. And I've made enough that I actually still have enough left on the table that if the next big move is up, I still make even more money. And by the way, I paid down my mortgage. I mentioned that in terms of keeping things real. I'm not betraying the cause of silver or gold or something. I'm just saying, it went way up. I had a lot of money unrealized.
I have now risk management move.
You're really egging me on with this Fed stuff. No, but
No, I know. I hear.
I don't want to repeat myself, but again, the object is to make money. And if you've only made money on paper, you haven't made any money. right? If you don't realize the gains, they're not real, like literally.
No,
You
excellent
know,
point. Excellent point.
and how bad would it be to be a long-suffering silver bull, finally be right, see silver in top $50, but not make any money?
Yeah,
Like,
that's
yeah,
wrong.
Yeah,
That just doesn't sound right.
But I still have more money on the table now, after taking profits, than when I started.
There you go.
Right.
Yeah.
And sorry, one more thing. Silver bulls especially, but gold bulls too. When I talk about taking profits, I'm talking about the stocks. I make money speculating on the stocks. Gold and silver bullion, I don't say it. It's basically, unless the house is on fire and I need to cash in on insurance or something like that, I only accumulate. So don't accuse me of betraying the metal here, right? I'm talking about locking in gains on these highly volatile securities, which, as you just said, the metals correct a bit, the stairs up, elevator down absolutely applies to the stocks. And that's why everybody should have a strategy for locking in gains.
Silver's sharp rallies often arrive late in a cycle, outpacing gold dramatically. Historically, this catch-up phase has signaled a final surge, but this time the spike was driven partly by a physical supply squeeze in London, sending borrowing costs higher and pulling in metal from global vaults. After the squeeze eased, silver returned to a more sustainable trend, reducing fears of an imminent cycle peak. For investors, emotional swings are normal, especially in mining stocks where volatility amplifies every move. The goal is not blind devotion to a metal, but disciplined profit-taking, patience during consolidations, and positioning for a multi-year bull market rather than a fleeting top.